thank you to you and your colleagues for hosting this important set of discussions today. They've been very instructive, and I particularly like that interchange you just had about scope 3, something important. So thank you to each and every one of you. And it's a distinguished panel we have, so I'm going to jump right in. You see their names and titles there. I'm going to ask each of them to describe a little more about their work. We're going to kind of kick it off to hear a little bit about them. But before we do that, I just want to give a little context, at least from my perspective, from CERI's perspective, and we're going to go down the line from Andre and Bob and Kara and Matt after that. So from our perspective, the world is changing. That a year ago, we had talked to investors and been talking to investors for a while about this, and there have been leaders. Obviously, CERI's been active in this for decades, and including some of our panelists today have been active with CERI's for many, many years. But the idea of net asset managers setting their own net zero commitment, that was something even a year ago that wasn't quite ready yet. 2 weeks ago, 2 days before the Biden summit, we announced with partners all over the world, in Europe and in Asia and other places, Australia and other places, at a webinar John Kerry joined us for, that there is now the Net Asset Managers Alliance and the Paris Line. There's over, for the net asset managers, there's $37 trillion of assets. $37 trillion of assets that have agreed, including, again, some of our partners today are on the call, agreed to be net zero by 2050, agreed to set interim goals by 2030, and take other steps. That's something that didn't exist. So that's great momentum. John Kerry called it, said, we're close to a tipping point on that. So I am very optimistic. The combination of all the discussions you've had this morning about technology and other things, about the role of investors. So there's so much more that I want to say, but we have such a distinguished panel and little time. I want to jump right in. So I'm going to jump into Andre. Have you kind of give a brief overview of your role and kind of your company's perspective on the role of investors broadly and net zero. Over to you.
Thank you, Stephen, and thank you for having me on this very distinguished panel. My name is Andre Bertolatti, and I head up Sustainable Portfolio Strategies for the Multi-Asset Group at BlackRock. And Steve, like you said, it's been an exciting start of the year for the Net Zero Initiative. At the beginning of the year, our CEO and our executive group made a commitment to support the goal of net zero greenhouse gas emissions by 2050. And to do that, we've identified 3 key areas that we'll take action this year. And I'm sure we'll develop those in the call today. The first one is going to be on measurement and transparency. We've committed to publishing a temperature metric for public equity and bond portfolios where the data permits, as well as disclosing the proportion of AUMs aligned to a net zero now, and that's 2030, as you mentioned. And we also will be delivering a climate analytic tool through our Aladdin Climate platform. Then on our investment management platform, we've integrated climate change into our capital market assumptions. And we published a report on that earlier this quarter. We're also implementing a heightened scrutiny model across our active portfolios. And this is now a component of our risk analysis. We're developing investment opportunities in the green economy, as well as launching investment products and explicit temperature goals. And also the third component of our action plan is to be more active in the stewardship activities. This year, we've outlined expectations for companies that we invest in to align to a below 2-degree warming scenario by 2050. So now we're asking for more disclosure on scope 1 and 2 across all sectors, and on scope 3 in carbon intensive industries. We're asking for decarbonization plans, and we're looking for knowledge of climate risk at the board level of companies. But we're also a public company ourselves, so we are made a number of commitments there as well. We're striving to meet the same standards that were set for the companies we invest in. So we released our first TCFD report, and we also released our first SASB aligned report. We're reporting on Scope 1 and Scope 2 and Scope 3 for our corporate operations. And we are carbon neutral today through the use of 100% renewable energy and emission offsets. So thank you for having me on the panel.
Well, again, we could spend the rest of the time just digging into all the topics you've raised there, as well as there've been a spate of articles about how BlackRock's voting and shares with the has evolved as well, and appreciate that and look forward to that. I'm going to move on to Bob in just a second, but as we get into the questions, also encourage our panelists to feel free to ask each other questions as well. So I'm going to turn to Bob Litterman, who is a leader, as all of you are in so many areas, and I've had a chance to work with Bob. Bob, your perspectives.
Thank you. Yeah, well, I have two perspectives, and I'll start with the one as an investor, and a founding partner at Kepos Capital. And I've come a little bit along a journey that I'd like to describe, because I started maybe over 7 years ago as an advisor to the World Wildlife Fund, and they wanted to, align their portfolio with our mission. And so we talked about divestment, but we were told, that, well, we could get down to a small amount of what we called stranded assets in the portfolio. But some of those, for instance, some coal companies we owned were in private equity, and we were told, that would be very expensive to get out of, et cetera. And our advisor, Cambridge, came up with what we thought was a very innovative solution. They said, enter into a swap where you sell your stranded assets to a counterparty and you receive, make it simple, the S&P 500. So we did that 7 years ago, and that had an amazing performance. I loved it because it was so simple. It was a bet that these stranded assets, which we defined as coal, tar sands, and oil and gas, would underperform the market. They underperformed by over 18% per year for 7 years, which is pretty amazing. So coal in particular kind of went bankrupt, got recapitalized, and went bankrupt again. And to put it in perspective, I remember one of my partners from Goldman Sachs, who had been in the energy area in investment banking, said, Bob, how could you be shorting coal right now? Its valuation is half of what it was a few years ago. Well, of course, in retrospect, and by the way, that partner is now working in clean tech. So, of course, we've all moved on. But the point being, it wasn't so obvious 7 years ago that we would have this incredible revaluation downward of stranded assets. And the question today is, are they still overvalued? And I would say, no, it's not obvious at all. And in fact, my firm has now moved on to looking for much more diversified opportunities, primarily on the long side in clean energy, clean tech, and so on. And of course, there's still going to be underperformance in some areas. So we are still, net short, for example, oil and gas. But to put this in perspective, and when you think about transition risk, the entire coal sector now is a couple of $1 billion of valuation. Tesla, as you know, is over $700 billion in valuation. And the fluctuation in the value of Tesla on a day-to-day basis is more than the entire value of the coal sector. And in fact, you have to add up the 4 largest oil and gas companies to get even close to the valuation of Tesla. So the point is, the market has really moved on in terms of valuation. And so when you think from an investor point of view of opportunities now, you have to be much more discriminating. So for example, in oil and gas, my firm started looking for, which of these companies are more attractively valued than others. And it turns out that's an interesting question, that when you go into it, it's very much fundamental analysis. And not surprisingly, it doesn't really turn on scope 3 emissions of those oil companies, which are huge, but they're not responsible for those. And if we were to price emissions, that would cause the price of gasoline to go up and the global demand for gasoline to go down, all of which is a good thing. But the implication is not that it will be difficult for a company that has large scope 3 emissions, but rather that the price of oil will go down on a global basis, and certain companies which will be very sensitive to the price of oil are going to be negatively impacted. Other companies will be less sensitive to the price of oil, may depend on the leverage of the companies and so on. So that's kind of the risk management perspective that I see. And frankly, that was, on the CFTC subcommittee that I chaired. And as you know, Steve and others, we had oil companies on that committee. And when they thought about their climate related risk, they were worried about the price of oil, but they weren't worried about their scope 3 emissions for the obvious reason. And then, you go back to, well, what about the banks? And, I'll let Kara talk about that, but are they worried about making loans to these oil companies on the basis of the oil companies' scope 3 emissions, which are now, I guess, called financed emissions? I was learning about that while on the subcommittee. But the point being, we have to be very careful about what are the risks that we're talking about, what are the data that we need, and for what purpose. And again, as an investor now, I'm trying to figure out which companies are going to outperform which other companies. And when I look at, for instance, the oil and gas industry, I'm going to be looking at the fundamental things that are going to affect the valuations of those assets.
Wow, just like Andre, I think we could spend the rest of the time just going deep on many of the points you said, both as an investor and again, for everyone in the audience. Bob, as he briefly alluded to, chaired the Commodity Future Trading Commission subcommittee on climate that came out with a unanimous report last October, 53 recommendations that really had an impact on shaping the debate. So I'm going to now turn this over to Kara, who's the global head of climate strategy at Goldman Sachs. Kara?
Thank you so much. It's really great to be here with all of you. I've been on since the morning, and it's been such a deep conversation on a lot of the really knotty issues around climate. So thank you, Bruce, for organizing, and Stephen for moderating this today. So I'll just start by saying sort of the way that I come at this at the firm is a little bit straddling sort of the corporate side of the house, advancing our own business practices, and also our work with clients. So I have the humbling opportunity to work with colleagues around the firm who spend a ton of time on climate, and a lot of what I do is help to bring those efforts together and then really accelerate them. Our view on climate as an organization, and there's an op-ed from David Solomon, which really outlines this in detail, that came out at the end of 2019, is really an acknowledgement that the magnitude of the challenge on climate is just sort of astronomical. And it is so significant that it's really an imperative for our firm, for our industry. I know Matt is gonna, I'm sure will echo a lot of these comments, given the focus of his firm as well. But this is complex, but it's an imperative that we work really hard, and we work with all parts of sort of the sector of the economy to be able to advance this. And we work hard with policymakers and others in the ecosystem as well. The way that we've really sort of operationalized this around the firm is sort of 3 prongs. The first is we've embedded this commitment into our work with clients, and I'll give you a couple of examples. The second is we've embedded it into our operations in the way that we manage our business practices. And then the third is we've put a really intense focus on identifying gaps that exist in the market and then working really hard, and in particular partnering with others who have a lot of expertise, whether that's in sort of the investor community, civil society, otherwise, your organization absolutely is one of those, to really try to move this forward. So on the first prong in our work with clients, we have a $750 billion commitment to deliver on sustainable finance by 2030. This is a commitment we came out with about a year ago, so we're a year in. It was a fast and furious year one, and I should say this was not sort of the first commitment we've had around sustainable finance or climate, but it absolutely was sort of the biggest and broadest. So it encompasses all of our businesses. It cuts across climate and inclusive growth. In year one, we did more than 1,000 meetings with clients, corporates, asset owners, asset managers, governments, pension funds, an incredible amount of activity. And we did 156 billion in sustainable finance activity. 93 billion of that was focused on climate transition. I can give you lots and lots of examples, of course, of that work, but what I would really focus on has been what a cross-divisional effort this really looks like, because I think that's one of the things that's really, really important when you think about the role that the financial services sector can play. Right, we can play a role as an investor, we can play a role as an advisor, as an issuer. And just to give you an example, we developed a Paris alignment toolkit in year one of this broad effort, which is something we use to work with carbon intensive clients. We piloted it with a series of clients in the oil and gas and utility sectors this past year. We'll introduce it to other sectors later this year. And what it does is it includes stakeholder-driven analytics to help companies understand and address risks related to how investors view them on climate transition. And then with those insights, that then extends to sort of an entire offering around decarbonization. It helps them think through strategic options, things like strategic M&A, acquisitions, ESG financing, supply chain management, kind of capabilities that really extend across all of our business to ultimately deliver on those goals and approaches. So that's really been, I would say, kind of the big impression has been there is so much capability that our sector can really bring to these issues. And Bob and Andre and Matt, I know all, we kind of each come at this with a series of really extensive capabilities. I think that's really important. The second prong is around advancing our capabilities, and this will address kind of where Bob left off on the financed emissions piece. This is really around how do we manage our firm sort of within the four walls of Goldman Sachs, but also around sort of the broader impact of our activity, whether that's with our supply chain, we have a net zero commitment by 2030, or whether that has to do with our work with clients, and we have a commitment to align our financing activities with the net zero by 2050 transition pathway. We've been carbon neutral since 2015 as an organization, have had aggressive operational impact goals, reductions in plastics by 80%, paper consumption by 70%. But I would say where a lot of the hard work is really happening, I know Matt will speak to this as well, is with this kind of long-term net zero financing commitment. We're now rolling up our sleeves and doing a lot of the hard work and looking at how we measure interim progress around that. And we joined the UN Principles for Responsible Banking. I just point that out because collaboration in this area is hugely important. We are still at an infancy in sort of what methodologies should be adopted and look like to measure this. And then disclosure and transparency, I think, is really key as well. We were one of the first banks to report under SASB in the US, and we'll put out our second TCFD report later this year, which will outline a lot of those commitments. And that's really going to be taking our existing practices around climate risk management and then integrating these net zero considerations into those goals and progress. So maybe I'll pause there. I know, again, there's so much we could talk about, but maybe I'll pause there in terms of overall approach.
I'm tired just listening, thinking about those 1,000 meetings and 156 billion, I think you said, of financing in the toolkit, and SASB and all the other things, the great stuff that you're doing, which is fantastic. So again, we want to get into some of those. So let me turn now to Matt, who's again the managing director and head of global sustainability finance at Morgan Stanley. Matt?
Thank you, Stephen. I'm going to try to use the rest of the 25 minutes just to tell you about Morgan Stanley and close it down there. But anyway, I'm honored to be on a panel with such illustrative panelists, and thank you to Columbia and Bruce to inviting us. I think there's a lot of similarities from a Morgan Stanley perspective, as what Kara shared from Goldman and Andre and Bob from their institutions in thinking about climate. So I lead a team at Morgan Stanley that was formed over 12 years ago called the Global Sustainable Finance Group to really engage across everything that Morgan Stanley does to integrate impact, sustainability, climate into how we serve our clients and how we operate our firm. And I think that's really relevant because, as Kara pointed out, right, the topic of climate is quite broad. It goes horizontally. It's a massive topic. It's incredibly complex. It touches all of our clients. It touches everything we do. It touches the real economy and our client segments, and it represents a very significant. You can think about it as a risk, as an opportunity, and everything in between. At a high level, I guess I would talk about Morgan Stanley's climate strategy in four key buckets. The first is really around facilitating the transition to a low carbon economy, and we have a $1 trillion sustainable finance goal. We work across all of our client segments to provide the strategic advice, the tools and analytics, the financing capabilities to help our clients down this road. The second is risk management. climate risk, it was formalized in our board structure. It rolls up through our chief risk officer to the board risk committee, and is really something that is, again, takes a whole firm approach. The third is really around operational resiliency. So I think some of the, again, probably some similarities here to what you've heard around operational resiliency, thinking across our operations, whether those be data centers, our footprint, our sourcing, to really think about climate resiliency. We have a net zero or carbon neutrality commitment across our operations. And the fourth is really around transparency. So we were the first large US bank to commit to net zero, first large US bank to commit to net zero back in September, issued our TCFD report and have been a long supporter of that. And also to think about supporting the industry, the industry development that is necessary around this, right? The net zero commitment is one part of the puzzle. The way that I think about this is the net zero commitment is the North Star and sort of where we're heading. But to get there, you need a methodology to measure this esoteric idea of financed emissions. And so we sit on the steering committee for a group called PCAF, the Partnership for Carbon Accounting Financials, which is really a great industry-led global effort to develop the methodology for accounting this. And we just, as Stephen, you pointed out, now there's not just an asset owner or an asset manager net zero alliance, but now the Net Zero Banking Alliance, which was launched just a couple of weeks ago, which we were a founding member of, which I think really provides a great framework around sort of setting targets and management. So this is complex. It's not one thing. It's not one firm or even one industry is going to be able to address. It touches all parts of the economy, all of our client segments. And maybe I'll leave it there because I know that there's still 20 minutes left to get into the deep Q&A. So I'll yield back some of my time to the chair.
Thank you so much, and for all of your great work and leadership. So some of you have already referred to kind of the net zero effort from asset owners, asset managers, and banks. Maybe we just kind of go around again and ask you each in literally 60 seconds on either not just what your own firm is doing, which some of you have already talked about, but what you hear from others in your field and customers. So let's start with the same order, and the next question will go in the reverse order. So Andre and then Bob, what you think about all this?
Sure. So from the asset owner perspective, there's a real push from our clients to sort of help them travel this journey to net zero, help them understand what their exposures are, what their alternatives are for the portfolio, how to understand climate risk, and how to make these pledges and commitments. So I think, and we already touched on it as a group already a little bit, there's the idea that you need a framework and then you need measurement. And those things are evolving and becoming more clear. So both from the asset owners and from us as asset managers, we are getting a better understanding as to what we need to think of in terms of delivering net zero solutions, because that's really our job. Our job is to help sort of look at the economy, understand the movers, the laggers. As Bob mentioned, they're going to be, focused on the long side of the portfolio, let's say, and you're going to look at the innovators and the people who are leading the movement to net zero, and thinking in those terms with the realization that in the end of the day, it's going to be the whole economy that needs to move to net zero. I mean, we can certainly lean into the leading edge of this, but we all have to sort of move to a net zero, the laggers, the leaders, and the ones in the middle as well. So
Great.
For us, it's about measurement and transparency.
Great. Measurement and transparency, key watchwords for all of us. Bob?
Yeah, well, first of all, it's great that everyone now is talking about net zero and what does it mean, and it's a journey. But when you think about it, what I really like is it focuses on the fact that actually we're not on that pathway right now. And historically, investments, as I think everyone in the financial markets appreciates, and this was really clear from the unanimity of the CFTC report, investments flow in the direction of where we can make profits given the incentives that we have. And today we're not pricing climate risk. And so the flow of capital is toward the old economy. And we've got to change that. We've got to have a phase change. And that means that investments flow toward the new economy, which is the net zero economy. And what that means is that we have to price carbon. And that was the number one recommendation. Everyone gets that. But sadly, what that implies is the realization that we have not changed course yet. And incentives are so important, and those incentives are not yet in place. So when we talk about the net zero economy, going one level deeper, what we're really saying is that businesses have to recognize that there is going to be a cost to emitting carbon in the future. This is going to be priced, and it's going to be built into the profit margins that you're going to get on your investments. So whether you're buying an internal combustion car or an airplane that's going to last for 50 years or building a new power plant, you got to think about how much profit are you going to get from that investment. And that's a function of the strength of the incentives to reach zero. It's not just the current incentive, it's also expectations about future incentives and getting there as quickly as possible. And so that's all part of the picture, and it's happening, and it's happening quickly, and I'm really thrilled about that.
That's great, Bob. Kara?
So maybe a thought on sort of the corporate net zero from the perspective, of Goldman Sachs Financial Institution, and maybe a thought on that kind of asset manager, asset owner. I think one of the things that's so important, is going to be so important, is the estimates of the amount of capital that are ultimately required for transition. I know there's big deltas, but a report that us and Morgan Stanley were part of, that the Global Financial Markets Association put out at the end of last year, put it at anywhere from 100 to 150 trillion. Just an incredible amount of capital that's going to be required. And I think one of the things that, as we now go through this sort of target setting, come out with targets and start reporting, annually on progress, one of the things that is going to be so important is that there is sort of this mutual understanding that, this is not something that's going to happen overnight. And as providers of capital, I gave you the example of the Paris alignment kind of work that we're doing, these broad decarbonization offerings. A lot of our clients have very, carbon intensive industries have very significant commitments to reduce. And so what's going to be so important, I think, is there is that understanding and contextualization as the target setting happens and as the reporting on progress happens, that there is such an important role that needs to be played, by our industry and supporting all sectors of the economy on transition. So I think that's one. The second is for kind of asset manager, asset owner, and more of our advisory conversations. Net zero commitments, they signal a clear intent. That's kind of the North Star that Matt talked about. But when we start to get into these kind of incremental directional commitments, there's a lot that still needs to be worked out. It's way more questions than answers. I mean, very basic things like, should I be mentioned, like what portion of my portfolio should I look at as a sector by basis, portion of assets basis, portfolio basis, methodology, absolute emissions or emissions intensity. Even within emissions intensity, there's different ways to look at it. So a lot of our advice is just have a lot of clarity, because what a lot of stakeholders are going to look at is going to be how you're measuring that interim progress. That North Star is important, but how you're measuring interim progress is going to be key. So have a lot of clarity and transparency, do it in a way that is feasible for your organization, but be very clear around how you're setting those targets, how you're engaging in companies, how you're investing in solutions, and then measuring all of that.
Great. Very good. Matt?
Well, it's a shame when everyone, I agree with all the other panelists on the screen here. I guess I would just say maybe 4 very quick things. One, to Kara's point, it's complex and it's unique, and not, there isn't a one size fits all for any of this. And so once there's a net zero commitment, it's going to be a different process, path, and drive for every organization. 2 is it's prolific. To your question, Stephen, it's prolific, right? Across all of our client segments, we're seeing the conversation really accelerate around climate. And one of the things Morgan Stanley's Institute for Sustainable Investing has done since we were founded 8 years ago is to really try to put our finger on the pulse of our client community. So we do a series of surveys for individual investors, for asset managers, and for asset owners. And it's pretty consistent across all of them that climate is a top issue. And in fact, I think it was 88% of the asset owners that are investing thematically, climate and environment was the top piece. Maybe the last point is I think our clients are thinking about this, trying to find their way through this, right? For some, it's a differentiator. And for some, it's really a strategic priority or imperative, and thinking about it holistically. So whether that's retirement accounts or access to product, whether it's advice, whether it's financing tools, whether it's operational resiliency and access to renewable energy, all of these play into it. And so it's not just one thing for any one client. And I think that's something that's, when I see my colleagues across investment banking, asset management, wealth management, commodities, research, the topic takes on maybe a different direction, or the conversations maybe slightly different, but bringing all of those together for holistic solutions, I think is really important, and where the conversation's going.
This is incredibly complicated. And, I'm reminded of the expression, how does one eat an elephant? One bite at a time. So how do we address this? Kind of one piece at a time. It's very complicated. I'm going to go back again in reverse order. So start with Matt, following up on Bob's question or comment about price on carbon. And what do you think? And again, I'm going to ask you each to keep it to 60 seconds. What do you, is that part of the solution? Can we get to net zero without that?
Look, I think, Morgan Stanley's on the record, I think carbon tax is absolutely one thing to consider. I think there's a host of policy and, of enabling policies around the world that will help, potentially accelerate this. I think, the confluence of investor interest, of corporate strategic positioning, of regulatory regimes, I think there's multiple different components to the path to net zero. And I think all have a role to play.
Great. Kara, do you want to add?
Thanks so much. I think it's very important. I think the question is right now, is it really feasible and on the table? It's been interesting to see what was passed recently in the state of Washington on this front. But look, I think you really need as many tools in your toolkit as possible. And I think there are things like 45Q, which are going to be very constructive and helpful, which we talked about earlier. The more that we can create incentives for these technologies, and I should note the 100 to 150 trillion that I mentioned, there's a really substantial, it's in the report, there's a really substantial portion, which is, not yet available at commercial scale. And so all of these things, are going to be really important to get there. I think you can tell it's pretty notable, actually, the incredible amount of private sector commitments that have happened. And I think that's going to be an, continued important part of this, is kind of the leaning in and, record levels of sustainable debt issuance last year. Sustainable debt now prices tighter than traditional debt on average, 5 to 10 basis points. Record levels of flows into ESG funds last year. The vast majority of passive ESG funds have outperformed their non-ESG counterparts. I think that's all really notable. But it's really going to take kind of the all tools in the toolkit to really deliver. So I think it's only going to be additive.
Great. Bob, you already talked about this, but do you want to add anything?
Well, I totally agree with the previous comments, and I'll just say that I love when people are talking about incentives, because there's no question about are incentives necessary? Of course, that's what incentives are. They're things that change behavior. So if we're going to change behavior, we're going to change incentives. Now, they do come in different forms. So you can have subsidies of solar and so on, and we should. But as an economist, I do have to focus on the fact that they're costly when you subsidize things, whereas when you tax things, that's revenue to the government. And the other thing is, when you subsidize things, you're choosing winners and losers, you, the government. And when you're creating an incentive to reduce emissions, then you're creating the same incentive for everybody. And entrepreneurs, investors, asset owners, everyone is trying to figure out, how can I make a profit given these new incentives? And yeah, they're absolutely essential that we get them in place right now politically. And Stephen, I've been very focused as co-chairman of the Climate Leadership Council on getting a bipartisan solution, because again, bipartisan means that the expectation is it will continue, and that will be so much more powerful than a partisan approach to creating these incentives. Now, sadly, frankly, our political system is broken, and it looks like we won't be going down the bipartisan path, at least not this year. But, you know, I'm thrilled that the Biden administration looks like it's going to be putting incentives in place, many types of incentives. And, you know, the anticipation of those strong incentives to reduce emissions has created a very strong investment flow this year. And so, you know, these things work and we're on our way, but, you know, we have to move more quickly.
We do absolutely. Andre?
Yeah, sort of to add to what we've spoken so far, I see three things at play. There's a push, there's a pull, and there's a shift. And in the push component is this idea of a carbon tax and sort of like favoritism from the government on particular industries. They are pushing us collectively to move in a certain direction. But let's not forget, there is also a very important pull component. And these are sort of how customers, investors, consumers are changing their behavior and sort of helping align into this movement. And that creates a lot of incentives for solutions. And the shift components comes from the technology side of things. If we achieve grid parity costs for renewables, if we see an electric car as the cheaper alternative to a gas-powered car, the forces of the economy will align to make this transition happen. So those three things working together are going to help us move into this lower carbon economy.
That's great. That's great. Let's go back around again, starting with you on the issue of transparency and disclosure. Several of you have talked about it in your opening comments. It's very helpful. As all the panelists know so well, and many of the participants I'm sure know, the Securities and Exchange Commission is currently exploring the idea of requiring mandatory disclosure. They have a comment period now, and if anyone's listening who's not participating, I encourage you to take a look at that. Comments are due on June 14th. But let me just start maybe 30 seconds each going through. What do you think the Securities and Exchange Commission should require mandatory disclosure, or what do you think more broadly on this issue? Andre, start with you and then up to Bob.
Yeah, I think it's a great move forward. I think disclosure means better quality data, and we're all going to be beneficiaries of that. So that's fantastic. And hopefully that also sort of connects into a global a trend to have disclosures comparable, transparent, and verifiable for all of us who invest to have access to. And the other component is to have these frameworks that help people understand what to disclose. So, you know, like there's the criticism that there's too much data out there, too many disclosures, so sort of to focus these disclosures into sort of materially relevant data. That would be a good move forward.
Great. Bob, I know obviously this is a focus of the CFTC report, but if you want to talk a little bit about your work on disclosure, it'd be great.
First of all, I think the issue is not mandatory disclosure, as you know, in the CFTC report. Material risks have to be disclosed. There's no issue about whether that's the case or not. The question really is what's material, and that, it turns out, is an area where what we really need is cooperation between the private sector and leadership from the regulatory agencies to figure that out. So I'm thrilled that the SEC has basically said, let's move forward on this, and is asking for input. But it's not going to be an easy, okay, yes, mandatory disclosure. It's going to be, all right, what do we need to disclose? What's material? And that is very unclear, because climate risk is fundamentally different than traditional financial risks, which tend to be short term and for which we have a relevant history. Here we don't have a relevant history. It's an emerging risk, and it's going to play out over decades, not months or years. So that's something where there's an awful lot of work to be done. And the issues are transparency, consistency, making it, useful for answering the questions that need to be answered, and so on.
Excellent points, and those transparency is key. Kara?
Thanks. So just a couple of quick points. So one is, one of the number one pain points that comes up in conversations with clients is around sort of the ratings and disclosure space. There's a, alphabet soup. What's the difference between GRI, SASB, TCFD, WEF? What should I do? When should I do it? And so I think you cannot underscore how important this is for all of the points that have been raised. And I think it's very much a positive development. I would say a couple of things that are going to be important. Global harmonization is going to be absolutely crucial. So the proposal from the IFRS to set up a sustainability standards board, if you haven't seen, is worth looking at. That's, I think, going to be really important. And we're hopeful that the SEC works sort of in lockstep with that, because you can imagine the challenges of being in a place for global companies where you're having to do lots of different reporting standards. The second is to really leverage a lot of the hard work that's been done around some of the key frameworks that have focused on materiality, and SASB and TCFD, I think, are great examples. But SASB led an extremely collaborative process with both corporates and investors for many, many years to develop those sector standards. It was extremely iterative. So I think there's a lot of good work that can be leveraged for the SEC to really look closely at. But overall, I think this is definitely a positive development.
Great, thank you, Matt.
I guess I would just say it feels like Karen and I maybe wrote our notes together before this. I think the two things, yes, global harmonization, right? There's, to the extent possible, would be great because it's complicated and would, I think that's really important. And two, TCFD has really, a lot has gone into that on the climate side in terms of creation, in terms of feedback. I think today something like over 2,100 supporters across almost 80 countries, including 950 financial institutions, and emerging as a standard embraced across industries. And so I guess I would hope that doesn't need to regulatory regimes across the world, hopefully not reinventing the wheel for a unique solution.
Great. So, Bruce, let me just ask your advice. So I'd love to ask another round of questions, but I'm not sure if we can go over. So maybe do this. Why don't we ask everyone to spend literally a 20-second answer? And the question about corporate lobbying, you're all leaders in different ways. As you think about your personal and your firm's work, how does it relate? Is your climate decisions built into that? And are you members of the chamber or others that are challenging some of these? So let me start with a reverse order again, and just very quickly, your perspective on that, if you want to, and if you want to pass, that's fine too. Matt?
Great, thanks. We, Morgan Stanley engages broadly. When I look at SASB and TCFD at both our senior management and board level, have been very involved in helping shape those. And members of organizations across the spectrum around the world trying to, share our voice at the table, at multiple tables, across worlds and across geographies, across the world.
Thank you. Kara?
I would say, we've been really proactive as an organization. We think there's an important public policy response to all of this. And we talked about some of the key organizations. The Climate Leadership Council is one we're involved in as well. That have been, very proactive in advocating for some of these market-based solutions that we think are important.
Great. Bob, you mentioned the CLC. You want to add anything else?
Well, I would just thank, Goldman Sachs and all the founding members of the Climate Leadership Council, and they are across the entire business spectrum. To your point, the lobbying organizations representing U.S. business, the chamber, the National Association of Manufacturers, even the American Petroleum Institute have all supported market-based approaches. In other words, incentives, pricing carbon, and I thank them. So it is unanimous in the financial community, in the business community. The only place I know of where there's some fear of moving forward is the Republicans in the Senate, and that's kind of sad. Hopefully that will change soon. Hopefully
that will. Andre, final comment.
Yeah, thank you. So yeah, we are active in many of these organizations that are helping to set the standards and the framework for dealing with sort of the carbon economy transition. But I think another important component is engagement and sort of speaking sort of to companies. That's a form of, I wouldn't call it lobbying, but certainly understanding where our North Star is in regards to what we're expecting out of corporations. And it was really encouraging to hear your prior panel, Bruce, talk about all of these exciting initiatives that are going on, because that's where we're going to see a lot of the change happening.